Hello everyone. So let's start discussion on the special purpose vehicle analysis of the critical financial ratios for the road and the power projects. So in this video, we are going to discuss what is a special purpose vehicle for the road and power project, how to do their financial analysis, and what are the ratios are important for the special purpose vehicle in the power and the road project. So the special purpose vehicle are a non-recourse and ring-fence thing where the balance sheet ratio are not essential, and we are not going to the the borrower balance sheet or the sponsor balance sheets. So lender care about cash to reserve the debt across the 20 to 25 years. So here we need to understand what is a non-recourse and what is a ring phase to understand the critical ratios for the road and the power for the special purpose vehicle. So the non-recourse financing is a type of secure loan where the lender can only seize the pledged collateral, okay, and such as project asset or real estate if borrowing default with no personal ability to remaining debt. So we don't going to touch the balance sheet of the borrower in that case. Okay, it is commonly used in commercial real estate and large projects or the infrastructure project and high risk project. These loan generally carry higher rate of interest due to the increase the lender risk. So where we discuss the limited liability, asset back, higher cost and common applications. Non-recourse lender can only seize the collateral or the product which buy from that the project, but it opposite that what is a recourse. So lender can seize the collateral and go after other personal assets to cover the shortfall. So in the not recourse, lender can only seize the collateral, do not touch the balance sheet of the borrower. But in the recourse, lender can seize collateral as well as if he wants and to cover their losses, he can personal assets to cover the shortfalls to touch the personal assets also. And then we discuss on the ring face, guys. Ring face is also one of the most important concept if we understand the post special purpose vehicle in the infrastructure projects. So, ring phase is a financial or legal separation of specific asset fund or the operation unit from the parent company or the main company businesses, ensuring they are used solely for designated purpose and protect from overall risks. So, their objective is fixed. In fact, the protective behavior to main safety of asset obtain use of prevent funds from being utilized for unrelated expense to secure the asset case bankruptcy. So asset protection, budgetary grant, banking regulations, and the taxation. Estate planning. So these are the things we consider in a ring phase. So let's move on the topic. What is a special purpose vehicle and its critical ratios for the road and the power project? So, what is the difference between the special purpose vehicle and the corporate credit? So, special purpose vehicle project finance and the corporate credit. So, here repayment from the company cash flow. We need to think on the balance sheet or the company cash flow account of that company, how it will work. We analyze that thing. But in the special purpose vehicle, we only think on the repayment only from the project cash flow, how much the project cash flow is generated by that project, how much the project that project is generate the cash flow, that we will focus, not on the balance sheet of that company. Then the ROE and the PAT and the margin matter. So profit after tax, return on equity, or the margins will matter in the corporate credit. But in the special purpose vehicle, financial cash flow available for debt service is the king. We consider that factor, how much the cash flow available for the debt service is most important. The larger of the cash flow available for debt service, getter of the project, we do the special purpose vehicle. And the parent support available. So corporate credit, the sponsor, will be support if there is a losses, but in the special purpose vehicle non-recourse to sponsor will not responsible for losses, and we are not obliged to sponsor to track their personal asset and to pay the remain. So it's kind of risk is there. And then the corporate loan might be tenure of the 5 to 10 years, not more than that. But the special purpose vehicle loans are 15 to 20 years and back ended, it's the longer duration. So let's understand the cash flow available for debt service. The calculation, it's by the revenue minus operation and maintenance cost minus taxation, working capital charges and major maintenance reserve. So that's give you the cash flow available for the debt service. So let's move on the next slide, which is the key ratio for the special purpose vehicle in the road and infrastructure projects. So these are the below key ratios.